Canada's most important financial institution just made a change that sets it apart from its American counterpart, a change that some people are saying is risky for Canada's economy. Now, meanwhile, in the midst of a trade war, the Canadian government is helping the US dollar while the Canadian dollar remains low. But everyone online has misinterpreted this situation completely. Now, is this business as usual or a signal of Canadian weakness? And what does this all mean for average Canadians, their jobs, their money, and their investments? Let's get right into it. It seems like the only thing we're talking about in Canada these days is tariffs and this trade war, and it seems like there's always something changing. There's constantly changing details. It seems like the only thing that's certain is uncertainty. Things feel like they're changing every single day. I look at the timeline of how things have gone down. We had the original tariff threats. They were paused for a month. Then they came into effect on March 4th, and then we applied counter tariffs, and then half of the products got weirdly exempted. Then we had this past Wednesday, steel and aluminum 25%, and increased threats of 50%, with Ford saying that he was going to cut off electricity to the states. Things are changing, and they're changing almost hourly. And for central banks like the Bank of Canada and the US's Federal Reserve, this uncertainty is making it way harder for them to plan. And something major is happening here because each of these two similar institutions are handling things in completely different ways. And right now, we don't know which plan of action is going to be helpful and which one is going to be harmful. Back in June, it seemed that the Bank of Canada was signaling that they had finally defeated the inflation of 2022. Inflation had been conquered. And as a result, they started cutting interest rates, thinking that, hey, we're not going to see inflation, so we can safely stimulate the Canadian economy. And yesterday, they decided to lower rates yet again, except this time they're doing it preemptively. Now, let me show you a clip from yesterday's press conference, and you'll understand a lot better what I'm talking about.
Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. The Governing Council will proceed carefully with any further changes to our policy rate, given the need to assess both the upward pressure on inflation from higher costs and the downward pressure from weaker demand.
So they're preemptively cutting rates, assuming that the trade war situation is going to get worse and worse and worse, and that they'll need to implement these lower rates to help to prop up the Canadian economy, encouraging businesses and consumers to go out and spend more than they otherwise would, which also puts an upward pressure on inflation. But at the same time, it seems that they're uncertain about what they should even do in this situation because they think that the tariffs have somewhat of a stagflationary effect. That word sounds complex, but it's simple. It just refers to when you have low economic growth and also have inflation at the same time. It's kind of uncommon, and it's a bad place for central bankers to be because they can't tell whether they should move rates lower to help the economy grow, because in stagflation, the economy's not growing, or if they should move rates higher to prevent the return of inflation. That's the inflation part of stagflation. And it seems like in this high pressure situation that despite the uncertainty, they're defaulting to and making the assumption that the worst case scenario is going to play out and the Canadian economy will need to be put on life support. So they're lowering rates despite the admitted risk to inflation. Now, if you were a little bit more skeptical, well, you could also see this as a political move. There are massive programs planned by the federal government to support businesses if this trade war gets worse. Programs which would require billions of dollars of borrowing by the government. Now, a lower Bank of Canada interest rate means that the government can borrow this money at a lower interest rate. However, the bank claims to be entirely independent, despite the optics of their former governor now becoming the new Prime Minister of Canada. Here's what the current governor of the Bank of Canada had to say about this yesterday.
Regarding your second question, I don't have much to say. As you said, Mark Carney and I worked together here at the Bank of Canada. He was the governor. I was the senior deputy governor. Mark has now entered politics. The Bank of Canada operates independently of the political process. That is really important. And what that means is it comes with a responsibility. The Bank of Canada needs to stay clear of any comments that could be seen as political in nature. So I have no further comments.
So make of that what you will, but one thing we can say for certain is that the path that the Bank of Canada is choosing is a totally different approach from how the US central bank, the Federal Reserve, is handling things. Let me show you. This shows the interest rates that are set by the Federal Reserve in America, and it shows a different story from how Canada has gone about things. First of all, the U.S. didn't start lowering rates as early as the Bank of Canada did, waiting instead until September, this past September, to make their first rate cut, albeit a 50 basis point cut here. But up to now, they've only cut rates by 1%, and over the past two decisions, they've kept rates even, while the Bank of Canada has continued to lower rates. Now, this is a total rate cut of 1% from the US, while Canada has more than doubled that in terms of how much it has cut interest rates. And I found this quote from the chairman of the Federal Reserve, Jerome Powell, pretty interesting. Listen to this. He says, "Until more is known, there's no need to rush further rate cuts, with inflation still somewhat above where they want it to be at the 2% target, and the current high borrowing costs considered appropriate to lower it further." He says, "The new administration is in the process of implementing significant policy changes, and uncertainty around the changes and their likely effects remains high. We are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we're well positioned to wait for greater clarity." So while Canada is preemptively reacting to the tariffs that are not yet fully implemented, the Federal Reserve is taking a more patient approach. There are certainly risks to both moves here, though. If the trade war intensifies and things get far worse than people are even currently expecting, and people are kind of freaking out right now, well, the Bank of Canada's moves could look good in retrospect. But if not, these preemptive actions, not in response to current economic data, but responding to the constantly changing statements from the US president, well, these actions could risk reigniting inflation for Canadians, further devaluing their dollars and propping up the real estate market. I'm curious what you think of this. Was it the right move by the Bank of Canada, or was it a step in the wrong direction? Let me know in the comments. But meanwhile, while all this has been happening, there's been a ton of drama as reports have come out of Canada saying that they would be selling their US dollar bonds, something that some saw as a way of sticking it to that country or signaling a lack of faith in the US dollar. And it spawned from a rather viral tweet. The report said, "Just in, Canada files to sell US dollar bonds." This made people react very extremely, thinking that Canada was going to sell all of its US bond holdings, signaling that they lost faith in the US dollar or were attacking the US dollar, or at the very least, just didn't want to hold on to these assets. But the reverse is actually true. Because this interpretation is a misreading. When they say Canada files to sell US dollar bonds, they're not selling the US dollar bonds that they're holding. Instead, they're selling newly created bonds sold by the government of Canada, but denominated in US dollars. They're selling US dollar bonds, creating new ones and selling them in US dollars. Now, even this has been criticized, and we'll get to it in a second, but a day after this tweet went viral, well, we have the government of Canada coming out to clear things up. They say, on March 11th, the government of Canada launched a 5-year US $3.5 billion global bond. So they sold $3.5 billion worth of bonds, going into debt for $3.5 billion to raise US dollars that they can hold on to. And this has raised some eyebrows. Some people have criticized this because they're choosing to issue bonds in US dollars instead of how they would typically issue bonds in Canadian dollars. It's got some people thinking, hey, I thought we were supposed to be in a trade war. Doesn't selling bonds in US dollars instead of Canadian dollars increase demand for US dollars, as investors need to purchase those bonds that you're selling in US dollars? Why not do this in Canadian dollars like the rest of your bonds? But the Canadian government says that this is all part of their long-term plan to keep a bunch of US dollars on hand as a government, and they're raising the money by issuing these US dollar denominated bonds. They're borrowing 3.5 billion US dollars to keep that money on hand. They say it's important because these funds can be used in the event of a liquidity crisis where all of a sudden it becomes hard to get US dollars. It can also help to support the Canadian dollar if needed. It's kind of like a hedge or some sort of insurance to not only hold Canadian dollars. If you think about it, investment funds, mutual funds, pension funds, everyone does this worldwide, and other governments hold other currencies for similar reasons all around the world. So at first glance, it seems kind of reasonable, but then when you take a closer look, it seems less so. Because also in this press release, they say that, they issued this $3.5 billion of new debt, these new bonds, at a spread of 11 basis points over the 5-year U.S. Treasury. That sounds complex. What does that mean? Let me explain. Right now, you can buy American bonds, a 5-year Treasury bond, and it will pay you an interest rate of 4.028%. Now, the government of Canada knows that if they sell bonds in US dollars and don't offer as good a rate as that, well, people won't buy them. So instead, they offered it at an 11 basis point premium, meaning that if this were to have happened today, this 4.028 rate would go up 11 basis points, or 0.11%, and it would be 4.138% that they'd be offering on their bonds, a premium above what the US would offer. But that raises the question, well, why not just issue the typical bonds that you're issuing in Canadian dollars? Because of the Bank of Canada continuing to lower rates, well, the government of Canada can borrow Canadian dollars at a rate of around 2.6% right now. So why not, instead of borrowing at borrowing at 4.3%, why not just issue this in Canadian dollars, borrow at 2.6%, and then convert that Canadian dollar that you've raised into US dollars via foreign exchanges? Like, to me, it seems like a pretty inefficient way of doing things that doesn't make a ton of sense. Maybe I'm missing something here, but apparently it's not out of the ordinary. They say the government of Canada last issued a US dollar bond in April 2024, also worth around the same amount, 3 billion, 3.5 this time. So this popular tweet that made people think Canada was signaling a lack of faith in the US dollar, well, it was totally misunderstood. But even what actually happened that we just went over, in reality, that in itself isn't above some criticism. But with all of this stuff happening and with information coming at you 1,000 miles per minute, it seems, what can average Canadians like us do when it comes to our jobs, our money, and our investments amidst all of this constant change? Well, first, when it comes to jobs, there's really not a lot we can do to impact whether or not this trade war continues. At best, I think my advice would be to vote for whoever you think is going to effectively de-escalate the situation, leading to more business growth in the country and hopefully more competitive jobs. But when it comes to money and investing, there's more that you can do, or perhaps it'd be better to say there's more that you can not do. Now, I always talk about investing as much as you possibly can with this general outlook and sense that eventually we're going to see inflation and money printing return, and that will devalue your savings like we saw during COVID while propping up asset prices like stocks and real estate. Now, I often recommend people first look into diversified index ETFs that are low fee, ETFs that give broad exposure to the markets. Instead of picking individual stocks where there's more risk that that stock could go down, you get access to a bunch of different stocks all bundled up together. But there are a couple caveats with that I need to bring up. There's some common advice that you should keep a 3 to 6 month emergency fund, and that should be your first goal before you start investing. Now, I think that's pretty good advice, but I think it's misunderstood. Now, that emergency fund isn't to just make you feel good and make you feel safe in case you lose your job, knowing that you have a cushion of money. The more important thing about it, while all those things are also true, is to prevent you from needing to sell your investments. You see, investments, in my eyes, should largely be, for most people, set it and forget it style, where you purchase investments that you're not going to need that money for a long time, right? So that you can have more time in the market, because as a lot of people say, time in the market will always beat perfectly trying to time the market because, well, the reality is most people don't time the market perfectly. So if you have investments right now, well, make sure that you have an emergency fund so that you know you're not going to need this money in the short term. Because right now, if you're constantly checking your portfolio, especially in times like these where there's a lot of ups and downs, and mostly downs as we're speaking right now, well, that can very easily spook you and make you feel like you need to sell that if you need that money soon. If you have an emergency fund, you're not going to need your investment money in the case of an emergency, and you're not going to be forced to sell at a very inopportune or at the bottom time. Also, when there's a lot of ups and downs, even when it comes to diversified index ETFs, when it comes to buying, you need to make sure that you dollar cost average as much as you can. If you take a big sum of money and invest it all today, and then tomorrow you see the stock market tumble, that could be kind of stressful and not the best situation. But instead of buying assets in one big chunk, I always like to, as much as possible, a dollar cost average, which means buying small amounts of assets each and every day, so that at the end of the day, at the end of the buying period, you end up with the average price over the course of the period of time that you're buying, instead of just choosing one individual day. Now, this can help you get a better average price, or at least an average price that removes the risk of any sudden movements. Now, obviously, all this isn't specific tailored financial advice for you and your situation, but it's what I'm personally doing. So let me know what you think of that. And let me know what you think of everything that we've talked about today. The stuff going on with the Bank of Canada and how they're changing relative to the Federal Reserve, and what's happening with these US dollar denominated Canadian bonds being issued. It seems a little bit odd to me, but maybe I'm missing something. If I am, let me know in the comments. I read every single one of them. And I'm just trying to figure out this like anybody else. And if you haven't already done so, subscribe to the channel. More content just like this and long form podcast content in the Russ Matthews Show. That'll be coming out again in a few days. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.